Well, good afternoon, everyone. Welcome to this week's Mortgage Minute. My name is Art Alvarez with MortgageWorks. It's the first day of August. Can you believe that? Seems like Christmas was just very recently. And then the other thing interesting is out here in the Palm Springs, where we're located in the greater Coachella Valley, we've actually had a kind of a chilly day almost. It's only 101 degrees. So those are the kind of days where we sometimes have to wear a sweater out here. But anyway, as you know, I always like to start this program with a interest rate report or update. So Jeff's going to pull up our interest rate grid from the website, from our website. And I've got some pretty good news in that regard. As you can see on the grid, if you take a look at it, we're seeing a little bit more, downward trend in rates. The conforming 30-year fixed, with good credit scores, we're getting all the way down to just over 6%, 6.125. And then when you got FHA and VA is now getting closer to the mid fives. Even jumbo loans, we're looking at now getting into the lower sixes. So this is really, really good news. It's definitely a positive trend. So I'm happy to be able to report that to you, that things seem to be going in the right direction. And in particular, what's driving this is the other really good news, at least as of today, is that 10-year bond yield, which I always remind you is your best barometer to track the direction of mortgage rates. Believe it or not, we're back under 4%. Jeff just pulled up that 5-day chart. Again, this chart goes from last Friday up until today. And as you can see, that's got that nice slope that we like to see, where we've now dropped as of today under 4%, right around 3.98%. So that's really good news. And that, of course, is basically a good indication of why we've seen these improvement in mortgage rates. So in that respect, what's going on? What's causing this improvement, which I think to some degree is unexpected? Let's jump into that. A few different things in terms of data points. Jolt, I guess we can say Jolt jolted the market this week in terms of interest rates. Jolt, as you remember, job opening and labor turnover. This indicates how many job openings there are in the U.S. And it dropped a little bit again, down to 8.18 million in June. It was 8.23 million in May, and it wasn't too many months ago. This number was pretty well over 9 million. When you see less job openings, that's an indication of a cooling labor market. And again, the labor market actually has a pretty big effect on where the direction of rates are going, and I think we're starting to see more and more evidence of that. I do also want to point out, though, as sort of a countercurrent, Case-Shiller, that's the Case-Shiller Index. As you may recall, that was an index created by a professor at Yale, Robert Shiller, some number of years ago. In fact, he predicted the crash of '08. And they released their index for the month of May. Of course, remember, that's a lagging indicator. This index is not up to the minute current. So they just released the numbers for May. And again, it reached a new high, 11th consecutive month. We'll come back and talk about that a little bit later when Jeff comes back on for our Q&A. And the other thing that occurred this week is the Fed did have their meetings this week, Tuesday and Wednesday. And as anticipated, they concluded those meetings and did a press release. Chairman Powell did after the meetings were over. They left, well, they say interest rates, but it's the Fed funds rate specifically. They left that unchanged. But the commentary from Powell was positive, making comments about continuing signs of improving inflation, and hints that we will in fact see our first rate cut in September. The futures market for the Fed funds rate is definitely betting on that. Very high probability that will occur. If it does occur, it's probably going to be 0.25% reduction in the Fed funds rate. And then the other data point that came out today, the S&P U.S. Manufacturing PMI, that's Purchasing Manager Index, forecasted at 49.5. It actually came in at 49.6. But that's the first time in 7 months it's come in below 50. So that, again, is an indication of a softening economy. Now, the other thing that came out today that's not on our chart here is the jobless claims, new claims for unemployment insurance. Pretty big jump, 245,000. It was 235,000 the month before. And I think that's what we can attribute to the pretty good improvement, the very good improvement in the 10-year bond yield. And of course, if you look at the stock market, it's off almost 500 points. So that is another indication of a cooling economy. Job market looks to be getting a little bit softer. And in fact, tomorrow, the data points that are of particular importance is going to be the employment report. That's the report that indicates the number of new jobs for the month of July. It's forecast to be 185,000, which will be a down number. And then, of course, the unemployment rate, which, of course, last month was 4.1%. You may remember a few weeks ago, actually maybe a couple months ago, I had hinted at the fact that if we see the unemployment rate break the 4% barrier and go higher than that, that should be a pretty good indicator and a pretty good data point in terms of affecting the bond market and helping to improve yields. So we'll see what happens tomorrow. If this 185,000 forecast for new jobs proves to be true, or maybe even less than 185,000, I would predict that we'll probably see maybe some more improvement in these bond yields and maybe some more improvement in these mortgage rates. And just as a reminder, if you go back to right after Christmas, in fact, I can remember the day, December 26th, the 10-year bond yield got down to about 3.82%. At that time, here at MortgageWorks, we were quoting a conforming 30-year fixed rate at 6% with no points. So we're getting pretty close to that. We need another about 20 basis points, 25 basis points improvement in that bond yield. And if that does occur, then who knows? We could actually break that, what I think is a pretty significant psychological barrier of getting under 6% on a conforming mortgage. So fingers are crossed that that'll occur. We'll just have to be patient and see how that plays out. So with that, I'm going to go ahead and bring Jeff back because we're going to have some Q&A about a couple of topics, in particular the Fed and the Fed funds rate, what that really means, as well as a little bit more on that Case-Shiller index.
Here I come, Art. Sorry about that.
Hey, no worries.
A lot of things going on in the background.
Yeah.
I'm excited about the whole idea of the topic today, but it's kind of like, this knife cuts both ways. It's like when it's bad news, it's good news. And when it's good news, it's bad news, depending on where you're at, right?
Well, that's true. And, it's a little strange, and it's been this way for years. I've always told prospective clients and our current clients, it's a little, what's the favorite word these days in the news the last couple of days? It's kind of weird that, unfortunately, when you're in the mortgage real estate business, unfortunately, negative economic news can tend to be good for what we do, because usually when you have negative economic news, negative data points, a softening economy, you're getting into a recession, what does that usually do? It usually brings down interest rates. So it's a mixed bag. I mean, on the one hand, you don't want to see the economy really get depressed to the point where lots of people are losing their jobs and all that. But at the same time, for those who are able to weather that scenario, that environment, and maintain their jobs, and if they're in the market to buy a home, it can actually work in their favor and can be pretty good news. So that's why, as a consequence, it's sort of a mixed signal about, I don't want to say that we in the mortgage industry root for a bad economy and root for bad economic data points and numbers, but at the same time, admittedly, it can help us on the interest rate side, which of course has been a big issue in locking up the real estate market now for really going on a couple of years.
Well, today when I was out and about, and then I came home, and the first thing I did is I checked the stock market, and I said, "Oh my gosh, look at they're way down." And I kind of had this feeling inside, like, "Oh, but I bet those rates have dropped some more." And when I saw it under 4, I was pretty excited about that. So I know it'll have a positive impact, because before we get started, talk to us a little bit about the difference between the Fed rate and also the 10-year, and why those really don't mean the same thing when you're thinking about buying a house and interest rates.
Yeah, it's a very good question. And we have to explain this to our customers and our potential customers all the time. And by the way, one other comment about this, you mentioned the stock market. In that respect, one of the things that is also probably happening today with that 10-year bond yield is we can oftentimes have what we call a flow of funds situation. In other words, when the stock market sells off significantly, you can sometimes see a flow of funds out of the stock market and into safe havens like bonds, like treasury bonds, and that can help drive down the yield as well. But again, the good side of that is that'll help mortgage rates go down. But yeah, and back to the Fed funds rate and what the Fed does in terms of lowering or raising rates. And I always caution people that be careful about thinking that the Fed, thinking in a simple way that the Fed controls all interest rates. That's not technically true. When the Fed met this week, and they, of course, decided not to change rates at all, what in fact that really meant is the Fed opted to not change, or what we're anticipating, lower the Fed funds rate. Now, the Fed funds rate is one particular rate. It doesn't directly correlate with long-term, 15, 20, 30-year mortgages at all. The Fed funds rate is a short-term rate for overnight borrowing among member banks of the Federal Reserve System. So when the public, and when, of course, the media broadcasts, hopefully, let's say in September, that the Fed has lowered rates by 0.25%. Well, the knee-jerk reaction for most of the public is to think, aha, mortgage rates have just dropped 0.25%, because on CNN, they said the Fed lowered rates by 0.25%. Well, again, it doesn't quite work that way. There's no direct correlation. Mortgage rates really are driven more by bond yields. The Treasury bond yield is a good, barometer. It does correlate more closely to long-term 30-year mortgages, and as well, the other part of the bond market, mortgage-backed securities. So when the Fed lowers the Fed funds rate, there's not any direct correlation, but of course it helps. Obviously it does, because it is an indication that rates in general are starting to ease. What a lot of people should realize is that and you should anticipate this, for example, if you have a HELOC. Most HELOCs are tied to the prime rate. The prime rate does directly correlate to the Fed funds rate. So if you have a HELOC, or unfortunately, if you have a lot of credit card debt, if the Fed lowers the Fed funds rate, then what's going to happen is your HELOC rate is going to go down immediately the following month. Your credit card rate should go down immediately the following month. Why? Because credit card rates and HELOC rates are tied to prime, which is directly tied to the Fed funds rate. But when it comes to mortgages, it's kind of a mixed bag. In fact, when the Fed announced yesterday after the meeting that they were going to leave rates unchanged, we had already seen some improvement in the 10-year bond yield. But immediately after the announcement, the bond yield actually creeped back up. It was down to like 4.8, 4.9, or I'm sorry, 4.08, 4.09. And then by mid-afternoon, it was back up to about 412. Now today, as we saw the market opened, I think it sunk in about all this positive hints and indications from the Fed that they're going to probably start reducing the Fed funds rate in September. So that was positive news. I think that helped the bond market open up in a more favorable position. And then you add into that this big jump in unemployment claims. That's a pretty strong signal. Hey, the economy is slowing down. More people are having to apply for unemployment. Add that to the earlier week's JOLT report, where the number of job openings is shrinking. You add those two together, the bond market says, wait a minute, we've got a softening economy. That's what really drove the improvement in bond yields and therefore mortgage rates, not a direct correlation to the Fed funds rate directly. So,
well, I did notice as you were going over the MortgageWorks rate chart that your home equity line of credit and HE loans are now really close to 8%.
Yeah, that's a good point, actually. In fact, I meant to mention that earlier when you had the grid up. On the HELOC side, we have that particular product that has become really attractive and very aggressive on rate, and that's that fixed line HELOC. It's a home equity line of credit, but the interesting thing about it is it features a fixed rate for the term of the loan. It's not a variable rate loan like a traditional HELOC. And so with that fixed line HELOC, if you are at a good credit score level and you're willing to take a 20-year term, which actually is a pretty popular term to take, because most of those HELOCs are not huge in terms of loan amount, typically 50, 100, 150,000. If you've got a good credit score and your loan to value is decent, in other words, you have a lot of equity, yes, you can get a fixed rate home equity line of credit that will recast the payment lower as you pay down the balance, which is unheard of for a fixed rate loan. And you can get that thing at 8.25% with no points. That is really good when you consider that the prime rate currently is still 8.5. And so for a traditional HELOC, where the rate is based on the prime rate plus some margin, so as a result, the traditional HELOC is which is a variable rate loan, is going to be more like in the 9.5, 10% range. To get a fixed loan, I'm sorry, a fixed rate HELOC that low, that's pretty attractive. And we're seeing a lot of activity, a lot of interest in that particular product.
Or like that. Thanks for it's a little diversion from our topic today, because I want to talk about an article about Case-Shiller. And first of all, exactly what is Case-Shiller, and why should we be concerned about that? As far as home buyers.
Well, the Case-Shiller Index was created several years ago. There's a professor from Yale, Robert Shiller, who is sort of well known and almost famous essentially for he studied the housing markets for years. It's sort of become his specialty. And back in 08, as we were approaching 08, 2005, 2006, he was sort of a lone voice, kind of trying to get everybody's attention that, hey, folks, we're heading to a problem here. And he predicted that we're going to see a pretty significant crash in home values. And of course, he turned out to be accurate. It turned out to be a true prediction. So of course, that gave him a lot of credibility. And due to that early work, he created this index where they study home values in 20 different markets across the U.S. And then they publish this index on a monthly basis, to everyone, to give the markets an indication of what is going on with home values at a national level. And so it's become really kind of the authority on home values and the direction they're going. And, most market participants probably pay attention to this index more than any other.
Well, in the past, you have made it really clear that this is a supply and demand type of thing, as well as it's like that double pressure of there's a lot of people out there with a low interest rate not willing to give that up as far as moving on. Because I think you mentioned something about, like, here in the state of California, there's an average of how long someone will stay in their home. Was it like 5 or 7 years?
Yeah, the average, and I'll get a little technical here. It's in the mortgage industry. It's called prepayment speeds. And most mortgages, particularly in California, the prepayment speed is relatively quick. In other words, the average life of a mortgage in California tends to be somewhere in the range of 5 to 7 years before that loan is paid off. Now, that payoff can occur for a lot of reasons. People end up deciding after a few years of owning a home to sell it and move and buy somewhere else, and of course the loan gets paid off in that scenario. Or of course, as has been the case, particularly back in 2020 and 2021, and previous refi cycles before that, when rates fall, people refinance. And so they end up paying off their loan much quicker than that 30-year term. And it's a very different scenario. Again, I'm an old guy. I got in the business 43 years ago. And when I did in January of 92, the idea of refinancing your home was just not a common thing. In fact, it was almost viewed as sort of a negative, like, you must be having financial difficulty. We didn't really have the kind of pricing mechanisms we do now, where we could offer rates with 0 points to the borrower and all that stuff. And so, and of course, the cost and the process of refinancing your loan way back then was more cumbersome, and it was more costly. So the industry has gotten much more efficient in the refinance side of the business, as well as the costs have driven downward. And as a consequence, people will be more aware of the opportunity to refi and will strike that opportunity when they see it. And that's another reason why these prepayment speeds on mortgages tend to be much quicker than they used to be. So, and that was, again, as part of our program last week, why I pointed out after the crash of 08 and the elimination of all these risky ARM loans that adjusted monthly and gave you these 4 payment options and created negative amortization, out of all the ashes of all that was these hybrid ARMs with these, 3, 5, 7, and 10-year fixed periods. They were designed with that in mind, that most loans are not going to last beyond particularly that 7 or 10-year period. So why not give the borrower a program that gives them a little bit better deal on the rate, but for a shorter fixed period of time, because the bet is they're probably not going to keep that loan past the fixed period anyway.
Well, with that loan speed, if you will, Are we seeing that ease, or is it still in a situation where the pressure is on the housing, because we're still seeing appreciation? Now it's not as much as it has been, but in this case Schiller, we're still seeing appreciation. What's your thought on that?
Yeah, well, first of all, the prepayment speeds, I would argue, have slowed a little bit, only because the refi side of the industry has slowed down to a trickle of what it was a couple of years ago. But that in itself doesn't really affect the Case-Shiller index in terms of home values per se. And one of the things we've seen, in fact, in this latest release in May, and again, this is a lagging index, it's not current up to today, the year-to-date appreciation in home values, again, in the U.S. as a whole, 4.1%, which is the fastest start of the first half of the year in terms of appreciation in 2 years. What is that attributed to? Well, it's been the continued lack of inventory. So even though we can say, well, there's not a lot of buyer demand because they're on the sideline, well, that is somewhat true, but the inventory levels have been so weak, so low, that even with muted buyer demand, it has still caused home values overall to go up despite that muted buyer demand and despite these high interest rates. And so that's been the situation, that while all these home buyers who are afraid of current rates, and maybe there's an affordability issue to where they can't qualify for these rates, but I would argue a lot of people can, they just don't want to. They've been waiting, and I think waiting has cost them, because these home values have continued to go up. Now, what's happened and the evidence in the last couple of months, which is not showing in the Case-Shiller index yet because it hasn't been released for June or July, there is more inventory. Inventory is growing. We are starting to see longer days on market. We are starting to see more in the way of price reductions on new listings. So that is going to translate into this index. This Case-Shiller index is probably going to show some reduction in that appreciation rate in the most recent couple of months. In fact, even this May number was a little bit down from what it was in April. In April, it was over 6%. In May, it dipped under 6%. It was like in the high fives. And then overall, it's been 4.1 for the first 5-6 months of the year. So the indication is we may see some softening in that appreciation rate of new homes nationally when the index is released in June and July. But even though that is probably going to happen, I would argue don't put too much into that, because I don't think that portrays that we're going to see a significant reduction in appreciation values or appreciation rates. Why? Because if rates keep improving, which we all hope they do, that should bring out more buyers. And if you bring out more buyers, and there is huge demand of buyers from the sidelines, when those buyers start to come off the sidelines, particularly I would argue if we get under 6%, that's a huge psychological barrier. So if that happens, then even the expected reduction in the appreciation rate that is likely happening now, but not in the index because it hasn't been released, is probably going to stop and start to go up again. So I think the bottom line here is, if you're a prospective home buyer, overall, I think that lower rates is good news. It's not bad news. And there is, in the last couple of months, some improvement in home prices. Not a lot, but some. And I think that's good news too. And that's why I think, and I know it sounds like a pitch, when is the best time to buy? But I think right now, current conditions are really a good scenario for looking to buy a home now. Could rates improve further to where you feel like even current rates, better as they are, you should hold off further? I don't think so. You should get into the market now. And if we get some more improvement, really good improvement into the fives, mid fives, low fives, or maybe even high fours, then you can refinance again, 6 months, a year, year and a half, 2 years from now. And that way, in the meantime, you've gotten that home. You will be able to take into account the appreciation that's going to occur. That's going to be in your favor. And then when rates really improve significantly, then you can refinance.
So what I hear you saying is, if you're on that sideline and you're waiting for this magical moment of the rates to drop, it may be too late, because then this flood of buyers will come on, which will drive what inventory we have up, the demand, and it'll drive the prices up. So that waiting, you lose your advantage. But right now you're saying, hey, this Case Shiller's lagging a couple of months behind. There really is some inventory out there, and you're starting to notice some price reductions and longer days on the market, which puts a buyer in a position to say, hey, I can negotiate and take advantage of this. And the rates have been dropping. Is that what you're saying?
That's exactly what I'm saying. That's the scenario that I see playing out right now. You know, in the Case-Shiller index, when it was released, the press release that came with it basically commented on the fact that those buyers who've pursued the strategy of waiting for lower rates and lower home prices, it has proved costly for them. Why? Because the home prices did not drop. They have continued to go up. Now, albeit they're going up at a slower rate, and they will go up at a slower rate further in June and July. But boy, if we keep seeing this 10-year bond yield under 4, and we can maybe break that 6% barrier and get into the 5s, you know what? Those buyers sitting on the sidelines, you need to get off those sidelines and take a look at what's going on right now in the market, because home prices have fallen a little bit. There is more inventory. There is a lot of talk among realtors. Again, I'm in the Greater Palm Springs Realtors Association. I'm on the board of directors. A lot of talk that there's a little bit of a shift from a seller's market to a buyer's market. So you've got some leverage. And of course, as we've talked about before on this show, and I harp on all the time, part of that leverage is you can take advantage of these pretty good rates right now and submit offers with things like temporary buy downs. In fact, on our website today, I didn't actually comment on it, but with rates are where they're at right now, I can arrange a 3-2-1 buy down for a home buyer. Your first year rate's going to be at 3.125.
Wow.
Well, that's what you've been waiting for 2 years, right? Now, it's not a 30 year you're going to be at that rate, but you can get a 3-2-1 buy down, start off at 3.125, and then have 3 years before you'll get to that 6.125. That's a great 3-year window. If the note rate really gets down into the 5s or low 5s or high 4s, man, that's the time to refinance, get out of that existing loan with the buy down. If it's not fully funded yet, you get that money applied to your loan balance at payoff time, and then you're locking in a lower note rate for a long-term period. So I think the conditions are great. I think prospective home buyers need to wake up, take a look, kick the tires, and you're going to find some pretty good opportunities out there.
I like that. Art, I'm going to put your information on the screen for those people who are saying, wow, this does make sense to me. It's time for me to get off the sidelines, get into the game. You can get a hold of Art at his office at 760-969-5023, or just call him on his cell phone, 714-612-9035. But do me a favor, this is a live show. Let's finish this up and then call him on his cell phone afterwards, because he is a wealth of knowledge. And at that point, Art, I'm going to bow out and I'm going to let you go. But hey, thanks for bringing us up to speed on, hey, where are we at in the marketplace right now? And is it the time to buy based on what we know, the data that we're getting? And I really appreciate that.
Sure. Thanks, Jeff. Okay, everyone. Let's go to our closing question from last week. As you know, that's a regular segment of our program. And here's the question. Interesting one, particularly in our market out here in the Coachella Valley. It's about the cannabis industry, and how does that affect a borrower's ability to get financing to buy a home if you work in that industry? And that industry, of course, is fairly prominent out here in our valley, particularly on the cultivation side. I work in the cannabis industry and would like to purchase a home, but I'm hearing that getting a mortgage could be a challenge. Why is that? Well, fundamentally, let's start with the fact that, of course, as you all know, cannabis at a state and local level, it's getting more and more common to be legal, again, at a state or local level. Not, of course, across the entire country, but in many states in the country, that is the case. But at a federal level, the issue with cannabis is it is still considered a Schedule I controlled substance. And a Schedule I controlled substance at a federal level is illegal and continues to be. What's the implication of that when you're trying to get a mortgage? Well, of course, there is a definite implication if you're going to need a federally backed loan. What do I mean by a federally backed loan? Well, that's going to be a loan that typically is insured or guaranteed by the federal government. The most common loan programs of that sort are FHA, VA, and USDA, because those are direct federally backed loans. Again, FHA insures the loan, VA guarantees the loan. Same with USDA. So that if a borrower defaults, the lender can submit a claim to those agencies and get reimbursed for their foreclosure loss. So for those types of loans, if you are an employee in the cannabis industry, you're not an owner, just an employee, or if you are a business owner, it's a no-go. I cannot arrange, no lender is going to arrange an FHA, VA, or USDA loan. The idea being cannabis-related income is excluded in qualifying because it's considered illegal income. And of course, the way these agencies write their guidelines is they don't say you're ineligible to get the loan if you're employed in the cannabis industry. They say, yo, sure, we'll make you a loan if you're employed in the cannabis industry. We're just not going to consider the income you earn in that industry. So you better be borrowing the loan maybe with another person, your spouse, your significant other, or a friend, and you're going to have to qualify based on their income, assuming they're not in the cannabis industry. Not too long ago, there was a little bit of an opening on this, a little bit of a little bit more of a opening in terms of a source of financing, and that's Fannie Mae. Now, Fannie Mae will allow, I can arrange a loan that will be sold to Fannie Mae, and we will be able to use your income if you're employed in the cannabis industry. So it's okay if you're a wage earner. That's what we call, someone who's not self-employed. And by the way, in terms of self-employed, this wage earner this wage earner definition means you're employed in the industry, you're not an owner, you're a wage earner, you're getting paid with a W-2 issued, or if you're an owner but less than 25% owner, you're not considered self-employed. So with that caveat, Fannie Mae will allow us to arrange a loan for you if you're employed in the cannabis industry as a wage earner, as long as cannabis is not illegal at a state or local level. So of course in California, that is the case. So we can make a loan for you if you're employed in the cannabis industry and not an owner. Now, Freddie Mac, on the other hand, considers the federal ban to be absolute. So they consider the income from cannabis industry to be illegal. And so Freddie Mac, as is the case with FHA, VA, and USDA, it's a no-go. So if we do get approached by a borrower who's in the cannabis industry as a wage earner, I can make that loan, but it will only be tagged for sale to Fannie Mae, not to Freddie Mac. And by the way, Fannie Mae and Freddie Mac often are perceived to be federal agencies, or loans they buy are federally backed. That's not technically true. Now, it's true that both companies were created by government charter, so they are considered what we call quasi-governmental agencies. They are overseen by the FHFA, the Federal Housing Finance Agency. It's a conservatorship situation, but they're not technically federal. And so that's why, at least in the case of Fannie Mae, they're willing to make those loans with those parameters, those restrictions. No owners of cannabis businesses, but only wage earners. Now, for an owner in the cannabis industry, let's say you own a dispensary or you own a cultivation business, there is mortgage financing available, but it's going to be in what we call the non-QM sector. That's the non-qualified mortgage sector. That's a sector of the industry where loans are made to people who do not conform to any of these agencies' guidelines, Fannie Mae, Freddie Mac, FHA, VA, and so forth. These loans, of course, have alternative documentation requirements, including low documentation possibilities for borrowers, such as bank statements only, P&L only, and so forth. So that segment of the industry will serve an owner of a cannabis business and provide you mortgage financing. But as we've talked about many times, that type of loan is going to usually involve a little bit higher down payment, certainly a little bit higher in interest rate, but that's the trade-off. You can still get the financing. So if you're in the cannabis industry as an employee or a business owner, and you're looking to buy a home, you need some help with financing in that situation, please give me a call. Give us a call. We'll be happy to discuss with you what your options are and provide you some written numbers to give you a better idea, a direct idea of what kind of terms are going to be available for you as a worker or a business owner in that industry. So good question. You do have some options, and so we'd love to help you with that. Feel free to give us a call at the numbers you see on the screen. And so with that, I'm going to go ahead and finish up with our closing question for next week. And it's an interesting one. And this is one that kind of touches on an issue that has sort of come and gone in the industry over the last several years. And here it is. We'd like to purchase a home, but don't have a 20% down payment. We've been told that to avoid PMI, we should consider getting a first and second mortgage combo that was described as a piggyback loan. Is that a good idea? Great question. And next week, I'll explain the answer to that, including what the heck is a piggyback loan, not to be confused with a piggy bank. So stay tuned next week for next week's edition of Mortgage Minute. I'll provide you the answer to that question, and it'll be on the house. So thank you, everyone, for watching and listening to this week's Mortgage Minute. I'm Art Alvarez at MortgageWorks, where we have the answers and they're on the house. Stay cool this weekend. I understand we've got a heat wave coming next week out here in the valley, Coachella Valley, Palm Springs. We'll be looking back at the 1-teens. So wherever you're at, stay cool. In the meantime, again, have a good weekend, and we'll see you next week. Thank you. So long.